Hey everyone, thank you and welcome back to our weekly live webinar. Every Tuesday we're here. Going to bring you some more information from Miss Charlene from Nationwide on the Care Matters. So it's kind of like a part two. We're going to dive a little bit deeper in. So if you guys had any questions before or previously, great time to put them in the box. We can review those. But again, like I said, she's going to come with a lot of new information or just dig a little bit deeper into the information we've already went over. So again, I hope you guys had a great Memorial Day weekend. Short 4-day week this week. So if you guys have any questions or if you need anything from us, let us know. 800-777-9322. Contact us if you need anything. Without further ado, Miss Charlene's going to take over and dive a little bit deeper into the product. Thank you, guys.
Awesome. Thank you. Thank you for that. And I will let you share that screen back with me and we'll be in good shape.
Here we are.
Awesome.
There we go.
Let me just blow that up. All right, we good to go there, Brent?
Yes, we are.
Awesome. It's perfect when it works after a long holiday, right?
Yeah,
Just
absolutely.
one extra day. We never know what might happen with us. Oh, good. Awesome. Well, I'm going to turn off my camera there.
Oh.
And make sure you're still seeing the screen.
Yep, I'm off. All right.
Great. Awesome. Well, now that we got that all worked out, thank you again for joining this morning, Brent. Thank you for having me. I appreciate the opportunity to dig a little deeper. From our last conversation, we kind of went in all things Nationwide, all the products we offer, and this is really a top seller for us, being the CareMatters, which is our individual hybrid long-term care, and we'll also talk about CareMatters together, and then we'll talk, some sales ideas and some underwriting at the tail end. And any questions, again, as Brent mentioned, drop them in the chat. We're happy to answer those as we go along. So we're going to start here first with CareMatters 2, and I won't dig deep, but CareMatters is our original version that is still available in New York. So if you have any advisors on the line or any clients that are in New York, we do have a product in New York. It'll function a little bit differently, so just reach out to Brent if you need more details on that. And then CareMatters 2 is in all of our other states, including California. They finally approved it this year, so it took us 6 years or so, but we are there. So CareMatters 2 is this conversation. What we think is really important when we look at the long-term care, especially in this hybrid space, is everything that we'll talk about today from a nationwide standpoint is fully guaranteed. So what do I mean by that? I mean, when your client comes in and buys this policy and they want a $5,000 monthly long-term care benefit, and that's the premium we solve for. As long as they pay that premium is guaranteed for the life of the contract. And we'll talk about different payment durations. The long-term care benefit that they will see on their illustration and ultimately their policy, everything's guaranteed. They can add inflation, those benefits are guaranteed. There's different money back options, and we'll talk about those, and those are all guaranteed. And then again, there's a death benefit at the end. So your client could use every stitch of long-term care that we'll show you in this sample here, and still have on the individual life, the CareMatters 2, a 20% residual death benefit for their heirs, all guaranteed. And oh, by the way, if they decide they buy a 10 pay and they get in 5 years, maybe they retire early or they just don't want to make those payments anymore, they can stop and we can have some guaranteed paid up benefits too. So when we think about long-term care planning, to us at Nationwide, that was really important. You have a lot of opportunities to take some risk with your dollars out there in the marketplace, your AUM, your 401ks, your stock purchases. But for the long-term care piece, we felt like having this one little bucket of safe, guaranteed money for the what if down the future was really important. So everything, again, is going to be guaranteed. Now, this is how the individual contract works. Whoops, let me do that again. What you're going to see is buckets. And if you're familiar with hybrids, they all work about the same here. So you're going to have that first bucket, which is the 2-year benefit. That's basically your life insurance bucket. And then if you want to add the extension of benefits, which I've never seen anybody not add in some fashion, it might be 2 years instead of 4. But that benefit, that second bucket, think of that as true long-term care. So that's why it's a linked benefit. We have the death benefit for the first bucket, and then we have the long-term care for the second bucket. We link those together to give your clients ultimately, in this example, a total 6-year benefit. So our example here is we took a male 55 and we solved for $5,000 a day for monthly long-term care beginning day one. We did put a 3% compound inflation. That's why you'll see that $10,400 at age 80. So the premium is paid in, and the death benefit that purchase is $120,000. So you see that $24,000, that's our guaranteed residual death benefit I mentioned. If the client goes through that 2-year bucket, they now get into this $240,000, which is that extension. So they have an additional $240,000 all in. If they did a 6-year claim, you can see where they would have gotten $360,000 back out of the contract. And if that 360 all was used up, again, that 24,000 still available for their heirs. There's different ways to slice this bucket. So this example is based on a 6-year. That's pretty common in the industry. You can do a 3-year extension, so you could do a total of 5 years. You could do 2 and 2 if you wanted to do 4 years. We do see that one quite frequently. And then we also even have a 7-year bucket, so you can go 2 and 5 for a total of 7. Just really depends on the client, their needs, how long they really want to plan for that coverage. So there's a lot of different ways to look at that. But again, this is our most traditional sold, is that 6-year benefit. So a little bit about the contract. It is a cash indemnity contract, as our CareMatters Together is too. We'll talk about that. What that means is that once your client is on claim, so either they have a severe cognitive impairment or they are unable to perform 2 of their 6 activities of daily living. So think they can't get themselves dressed, they can't feed themselves, they can't take a shower alone, those types of things. Once they are on claim, Nationwide will give your client 100% of that benefit. So in this situation, if we go back here to this guy at age 80, Nationwide's going to cut a check for $10,469. That's going to go to the client. We don't care what he does with that money. So maybe he has someone taking care of him and the family, and it's only costing him $8,000 a month. The other $2,000 he can give to his advisor and invest that however he wants. You can put it in a savings account, whatever the client wants to do with that. They can use that money however they want. We don't have any restrictions. They can add things like a lot of people will add wheelchair ramps if they need them to stay in their home. Think modifying a shower or bathrooms in general. They can do that. Pay someone to cut their grass. They want to stay home. They have someone coming in to take care of them. No restrictions on that benefit. We'll talk about all of these different options, the payment options. 1035 flexibility, that just means I can have a 1035 exchange, and if that's not enough to buy me the benefit I want, I can add additional premiums to that. That we didn't have that before on our CareMatters 1, so we added that flexibility. And we'll talk about all of these different inflation options and the refund of premium options. And then that retroactive payment on the elimination period, what does that mean? That one to me is really, really key, should be kind of a slide to itself. What that says is your client has a 90-day elimination period. And the reason for that is we want to make sure it is a long-term care claim. So if it's 90 days or less, we really figure most people are not going to need long-term care. Once your client, though, has gone through that 90-day elimination period, and now they're on month 4. So let's go back to our gentleman at age 80. He was going to get a little bit over 10,000. So for easy math with my brain this morning, let's say it was a level 10,000. Those first 90 days, he's getting 0 from Nationwide. But on that 4th month, his check is not going to be 10,000. His check is going to be 40,000. So retroactive to day 1. We make him wait out the 90 days, but on that 4th month, we pay him back those 90 days plus that current month. So that really can make a difference. When you look at a 12-month claim, he really does get 12 monthly payments out of Nationwide. So the premium payment options that I mentioned. So we've got single premium, 510, pay to 65, and then pay to 100. You have to be under 65 to get that pay to 100 option, but it is there. It will mimic a traditional long-term care option if you have clients that really just like that. That's a great option still in the marketplace. I love traditional long-term care, but this can actually put a plan in place for those that are maybe worried about what happens if that premium on a traditional contract might go up in 10 or 15 years. This way they pay to 100, they're locked in, there is no premium increase. Our most popular, I would tell you, is still the single and the 10 pay. That just seems to be pretty popular on the individual contracts. And then we have 3 inflation options. So you can do simple compound at 3%, or you can do a 5% compound. Again, our most popular one here is in the middle, 3% compound inflation. That just seems to be where people gravitate. There are some reasons and that I would share with you where you do a 5% compound, and we can talk about those offline if you want to know more on that. But really, it's maybe for those international type claims. If you have someone who's going to live out of the country, that 5% can be very attractive. And then I mentioned our return of premium options. So your clients have a choice. They have a vested, a one-time step up, and then C is minimum refund of premium with maximum LTC. I'll start there because over 90% of our cases are sold in that bucket. Why? Because that has the lowest return of premium to your client, but the highest long-term care benefit. So a lot of times what we see out in the marketplace is it feels good to say, yes, I could go with option A and get 100% of my money back at some point, but I give up enough benefit that it just doesn't really work out. And when we look at the LIMRA studies out in the market, less than about 2% of any long-term care, whether it's hybrid or traditional, less than about 2% are ever surrendered. And so that's why if you hear in the marketplace of rate increases or people trying to, the long-term care traditional companies trying to give you, here's some money if you take, if you exit your policy, or I'll give you this money and you can reduce your benefit or drop your 5% inflation. There's different reasons out there. People are not surrendering their contracts. So it's there if they want it. I understand those clients out there. It feels good. So our vested option says after 5 years, beginning year 6, you could get 100% of your money back. Our one-time step up says after year 10, first beginning of year 11, you could get, you're initially going to get 80% of your money back, and then at year 11, you could get 100%. So that one-time step at year 11. And then again, that maximum is just really going to give you the most long-term care. And again, where we see over 90% of our sales. And Brent, I can't see the chat box, so if there's any questions before I keep going here, I thought I'd ask.
I have one question, and it is age range for the product.
Perfect. Lead me right into it. So on our CareMatters 2, this product is available actually at age 30. So 30 to 75. We can go all the way up to 75. Awesome. And we hit the elimination period, so we're good there. One thing to note, it is a calendar day, so a lot of folks will say, is it actual days or calendar days? So 90 days, whether you were off 30 days in 1 month and you kind of didn't have to worry about getting any help. Maybe you needed help only twice a week. All of those days add up. So it's a calendar day elimination period. It only needs to be met once. I don't think we see frequently where people come and go on claim, but let's just say you did. If you had someone maybe that had a stroke where they were severely impaired for a time, so 12 months, maybe 18 months for full recovery, and then they were able to come off. If that person went back on claim, 5 years, 10 years, 15 years down the road, they wouldn't have to make that elimination period a second time. So only one time during the lifetime. All right, so that's our individual contract for the most part, and this is our joint contract I'm going to jump to, but again, I'll see if there's any other questions on an individual chassis before we roll to the joint. All right. So CareMatters Together, we just came out with this last summer. I can't believe it's almost been a year, but last June we came out with this product, and it's built on the same chassis as the CareMatters 2. So you'll see a lot of the things are similar. The benefit payments are going to be just a little bit different. As when I mentioned CareMatters 2, the individual contract, we could do it at 2 years, 5 years, 4 years, 8 years, or not 8 years, 7 years is the max. You'll see 8 years is the maximum on this joint contract, but everything else is going to be really similar. The thing that we changed in the joint product is, so we have 48, 72, or 96 monthly payments. And instead of saying, in my example earlier, I said 6 years is the most common benefit. Instead of saying 6 years on the joint contract, we've switched it to monthly payments. And I'll show you in some examples why we did that. but 4872 are 96 monthly benefits. This pool, when I show you these examples, is 100% shared. So if at age 80, there's $1 million long-term care bucket, one spouse could use it, you know, both spouses could use it. One can use it all up, one could use a piece of it. So I'll show you that, but it's a completely shared pool. Now, the elimination period that I mentioned before, that 90 days, that they still, each couple has their, or each person rather, has their own 90-day elimination period. So let's say he goes on claim first, hits that 90 days, is on claim for a couple years, and then the spouse comes on claim 4 or 5 years down the road, she would then have her own 90-day. But once those are met, the pool is 100% shared. So let's take a look at how this might play out in a claim. And I'm sorry, this is a busy screen, and I'm going to tell you to stay to the left there, 48, 72, 96. We'll talk a little bit about the right. But in this joint product, we have two classifications for the clients. They can both be preferred, or one can be preferred and one can be standard. Now, what do I mean by that? If you look to the left, preferred, that's the CareMatters individual contract. So the clients essentially is a preferred class if they can qualify for the individual product. If you had a client that would not qualify for the individual product, they could in fact qualify on the joint bucket with a preferred spouse. So I can't have two standards. I have to always have one preferred. But again, think preferred, I could get my own contract. Standard, I need a healthy person to get me my contract. And this really, you don't really probably care too much in the weeds, but how the buckets. I said the 2-year bucket on the CareMatters individual life. The preferred buckets have a 36-month payout, and then the standard, they start at 48 months. Too much in the weeds, you probably don't need to know about all those details and don't really care. At the end of the day, you're still going to get, if you picked a 96 monthly payout, you're going to get 96 months. It's just that acceleration is the second 60 months instead of the 24 months on the individual contract. But that's a little in the weeds. This will help eliminate a little confusion that might have caused. When we look at this contract, again, I said it's 100% shared, and we look at 96 payments. So again, that in our mind, that's 8 years, right? But in this example, you can see it was 10 years before all of these benefits are paid out. And the reason is because in our sample here, Monroe has gone on claim for 24 months. And then he came off claim, and it wasn't until that 4th year where Dolores needed to use the rest of that coverage. And then she had 72 payments left to her. So we're still going to make those full 96 monthly payments. There was just a gap here in the time of claim between Monroe and Dolores. Now, when we look at, well, what if they both went on claim together? That's absolutely fine. In this scenario, we have Stephen. He's been on claim for 24 months. And then Michael jumps in and he's on claim at the same time. So again, you can see that we paid out 96 monthly payments just over 6.5 years because we overlapped those two clients being on claim. So we're always going to pay those 96 monthly payments, just depends on how those are paid out. And then the other scenario is that we could have one person that would use every single 96 monthly payment. So in this scenario, John goes on claim and he needs them all for the 96 payments, total of 8 years. He has then used all the long-term care benefits. So in this situation, there would be no more long-term care for Lori. They can, again, slice and dice that however they want, but if they decided to go ahead and let John pull the whole contract, that is completely fine. Any questions before I get into some of the specifics, issue ages and the limits?
Yes, I've got a couple of them here.
Okay.
I think this is going to be off of the age range that was 30 to 70. It says individual plans versus couples, but I think that's what we're kind of going to now. So I'll hold off on that one. Is the pricing better for couple plans versus 2 individual plans?
Mm-hmm. Yep, you will find about a 10 to 15% difference in pricing, and that will, of course, depend on the duration that they choose or the health of the insured. So if we have 2 preferreds, you're going to see a bigger benefit. a bigger price difference, I should say, versus if you have a preferred and a standard. In that situation, it might be a little bit more, but again, we couldn't get 2 policies if I have a preferred and a standard, because that standard person would be uninsurable technically on an individual chassis. So yeah, definitely a decent difference in the pricing for the joint life.
Okay. And then I have, I think this may be a 2-part, but I'll start here. This is, do you have any idea how many companies address LTC? It seems like many have exited the LTC market, which lends Nationwide as one of the optimal companies for LTC. Then there is a second part, just to verify, when one passes, will that bucket go to the spouse so they have more available to them?
Yes, absolutely. So I'll start at the end there. When the bucket is here in the individual or in the joint contract, in this case, let's just say John, if you're still seeing my screen there, John only went on claim for 4 years. Then the remaining bucket is 100% available for his spouse here, Lori.
Awesome.
Yeah. And then as far as the carriers out there, there has been a huge shift for in that space. There are still a handful of individual carriers out there for the traditional long-term care space, and they're very good, good contracts and definitely viable. A lot of them have been in the space a long time. Mutual of Omaha is one in the traditional long-term care space. They've been there for a long, long time. On the hybrid chassis with the Nationwide CareMatters, you have 4 other, well, with Nationwide included, you have 4 or 5 other companies, a couple more that are coming in. One company was in the space and has decided to exit about 1.5 years ago, but you've got about 4 or 5 in the hybrid space. And we only have one other competitor in the space that has a joint policy. Theirs works a little differently, where it's a reimbursement versus cash. And there's some other differences in that product, but there's not a ton of people in the space, but a few more that are entering the traditional or the hybrid long-term care world.
Good deal. And then there is, let's see, it says, so there's only 2 rate classes, preferred and standard. Yep.
That is correct. And again, what that encompasses, if you look at preferred, that would be somebody who could, again, get individual coverage. It encompasses, actually, if you're familiar with the life insurance table ratings, a life insurance table rating up to D as in David. So they could actually be a table D all the way to preferred and qualify for that preferred classification. When we added the standard class, that actually encompasses people that are in the table 5 to table 8. So I think mild to highly rated. So up to a table 8, those clients can be considered on a joint chassis here with a healthy insured. The best example I have for that is, Brent, is we have diabetics out there all the time, right? And a lot of times we get calls, hey, they're a type 2 diabetic, can they get CareMatters? For the individual chassis at Nationwide, you have to have an A1C. If people are familiar with that, you're reading on how good your control is over your blood sugars. The A1C reading has to be 7.5% or less in order to qualify on your own 2 feet. When I switched to a joint product, I could have someone whose A1C was up to 8%. So that's decent control, not great control of a diabetic. So if you had someone in that situation, that person would be standard, and then the healthier insured would be that preferred. So we could put those 2 together.
Okay, makes sense. Definitely give you some range.
Yeah.
Let's see, it says, how does the CareMatters Life LTC compare to traditional LTC with underwriting?
So the underwriting on the CareMatters is actually really streamlined, really simple. You can drop an application electronically if you're so inclined, or we still take paper applications. It is an application, and we also have 2 options for the client. They can get a digital interview sent to them, which is basically that Part B medical exam. That can be sent to the client digitally to complete at their leisure, or they can still do a phone call. And that's it. That's really all the underwriting that we do. Now, if you're over age 60, you're going to need a cognitive phone call. Now, 60 to 75, the cognitive phone call is available. 60 to 69, we just rolled out probably less than 3 weeks ago now, that cognitive digital, we might have touched on that just a little bit last time. There is a link to the client. They can do their cognitive digitally, which is still a little mind blowing to me, but they can. So, and that's all we do. On rare occasions, we'll order APS. So let's go back to the diabetic example. If I had someone and they weren't real sure what their current A1C reading was, and I didn't have access to any labs, we would go after the medical records just to get a history on the sugar readings. But we have only about 16% of our cases or less that we are ordering APSs on. So we underwrite really on the digital exam that they give us and that cognitive piece.
Awesome.
Yeah.
So digital exam is definitely different, and definitely something you're going to see a lot more soon.
We have a really high adoption of that, and it's interesting because when you think about trying to make phone calls, people are busy, they're working, they're doing meetings like we're doing, and it's just an interruption in their day. So the digital part B, we are seeing that completed most of the time. I think the percentage was like 85% of the time it's done between like 9:30 and 12:30 at night. Most people are doing it right after their day. They're done with dinner, they're finished with their afternoon, and they're just sitting down at their leisure and completing that part B. And the digital cognitive, that's typically if they do a phone call, that's 15, maybe 20 minutes on the phone. Our digital is about 5 to 7 minutes it takes a client to fill that out.
Oh, wow.
Yes. It's amazing. And a lot of people feel a little put out, I would say, when on the cognitive calls. Not anybody's fault, not any carrier's fault. It's just questions that you have to ask. And people don't like to be, told, here's 5 words you have to remember, but you can't write them down, those types of things. So the digital is great. Where I also think these digital tools come into play, Brent, is when you have someone who's maybe there's a little bit of a language barrier. So we have the ability, and it's a little bit easier. Sometimes they can read it. Maybe they can't speak English as great, but they can interpret it on the screen. So
absolutely.
Yeah.
There's definitely going to be a lot more upsides to that. When you said that last time, I kind of thought about it for a second or two and thought to myself, boy, that's definitely something we're going to see a lot more of. And it's good, innovation is the way we roll here.
It is.
So I've got 3 more. I'm going to see if I can get 1 or 2. It says, okay, so what is the average time for underwriting for this type of policy?
Yeah, so that depends on how quickly your client does the interview. I've seen tickets, applications put in on Monday and approvals by the following Monday. So if they do that interview, we're about 4 days from the interview being complete to an underwriter taking a look at that file and getting the offer out.
Awesome. And then 1 more 2-part, and then we'll keep it rolling here. It says underwriting look back period, and what if DX at 9.6, but now at 7.0 or 7.0?
That one I would probably run past an underwriter. I'm not sure if 7.0 is still, boy, I used to have that range. I can ask an underwriter that question for you and get back to you on that one. That's a good question. I know I've asked that before, but I don't have that off the top of my head. I'll find out for you. Yeah.
Sounds good.
Absolutely.
And that's it. We'll keep rolling.
All right. Well, we are just getting to the little bit of the meat here. This is probably more than you want to know too, because Brent will know this for you, but most of the benefit, what that means is to get started in the contract, the minimum long-term care benefit is $1,500 a month. And then we have some outline states here that require a higher minimum. You'll see that when you run an illustration, or if you put in a dollar amount you're trying to solve for, and it bumps up your dollar amount, it's just usually bumping up that minimum LTC. It used to be $2,500, so since we've lowered it to $15,000, we haven't really had too much of a jump. But I did have actually somebody in South Dakota not too long ago. They're like, well, I can't put in what they wanted to pay, $5,000 a month. Like, well, it's because of South Dakota requires a higher benefit. That's the only time you'll see that if you put a specified premium in to solve, if it doesn't work out, take a look at your state. And then the maximum we do is $20,833. So I'm here to tell you we're open for that business. We'll take it. So we don't issue a ton of those on a monthly basis, but we can. I did actually have a large over $700,000 1035 exchange last year, and we did hit that threshold. you can still add inflation. It's just at issue. That's the maximum that we can have, but you can still put in inflation on those solves. So we'll take those if you want them. And then these are the issue ages we talked a little bit about. You'll see the max age is 70 on this joint product, right? So 75 was our individual, 70 is the joint contract. And then there's some specifications on the payment options. So if you're over age 65, I can't get a 20 pay or a pay to 100. But for the rest of those, the 10, the 5, and the single pay, I can go all the way up to age 70 on those options. And I will tell you, this 20 pay is new. So CareMatters, the individual, has a pay to 65. And then this one, we took out that pay to 65 and went to a flat 20 pay. We've seen a lot of pickup in this payment option, especially if you're looking at your clients in their mid 40s. It's really been a great option for them to take a look at. And then the footnote on the bottom doesn't come up a ton, but there is a 25-year age difference. If I have two preferred clients, they can be 25 years apart. And I've known some people that are 10 or 15 years apart in married life, not too many that I can tell you that are 25, but could happen. Or I could have a mother and a daughter in that situation that are 25 years, 24, 25 years apart. We could put them on one contract. And then the only caveat is if I do have that standard class, the max difference in age I can go is 10 years. Again, we don't see a ton of that. Usually they're all within a couple years, but it's there if you're interested. This just spells out a little bit more on those premium payment options. The biggest thing I want to point out, though, is this very bottom sentence. For all payment options, obviously, of course, not the single premium because you're one and done, but the premium will be waived while one person is receiving long-term care benefits. This is for the joint contract only. We have not added this feature to our individual contract. So if you're in a 10 pay on the individual policy, you're going to still pay those other 5 years if you've paid in for 5. In this situation, if I have a husband and wife on a policy and they have done a 10 pay, 5 years in, he goes on claim, those payments are waived. If he stays on claim for 5 years, so now I'm at 10 years in the contract, that's it, I'm done. There's no more premium to be paid into the contract. If he's on claim for 5, comes off at 7, we're going to pay year 7, 8, 9, and 10. There's no catch up to those back premiums while those were being waived. So that is a huge, huge differentiator in this joint product versus the individual. And it's built in, it's not something that you have to pick. These are the inflation options. Again, a little bit different than we looked at on CareMatters 2. So I have 3%, instead of 3% simple, I now have 3% compound for 20 years. I have 3% compound for life, and then of course 5% compound for life. The 3% compound for 20 years, again, looks very attractive if I look at couples in their 60s. It can make a pretty significant difference on what that pricing is for that couple. And if I took someone, let's say they were 65, I'm compounding it till they're 85. Average age of claim is between 80 and 83. So I've really compounded it for most of those years before claim. So just something to take a look at if you're really looking at someone who's very price sensitive. And then I think we already hit this pretty good, but again, non-smoker, we have tobacco and non-tobacco, standard and preferred. And I always have to have a preferred. Now I can have a preferred tobacco and a standard non, but I always have to have one preferred client in order to issue the contract. One little caveat, just in case you get offline and decide to run some illustrations. If you have a couple and one is preferred non-tobacco and one is preferred tobacco, you're going to find that to be cheaper than two preferred non-tobaccos. There is some, I talked to actuaries, I've talked to product development, and they just believe on a pricing standpoint on a joint chassis, if I have a tobacco user, that person is not going to go on claim. They're likely going to die from their tobacco use. So for whatever it's worth, for your smoker clients out there, this might look like a really attractive option for long-term care. And then again, we hit the elimination period already. It's the exact same in CareMatters 2 as it is in the CareMatters Together. There's that example I mentioned before, that month 4, your client would get that $40,000 check from Nationwide, and then they would go back to their regular $10,000 for the subsequent months. And the CareMatters Together has a guaranteed 10% residual. So again, it was 20% for the individual life. It's 10% on the CareMatters Together. So husband and wife both use all 96 monthly payments, and there's still 10% of that initial specified amount paid out to their heirs. And we won't touch on this too much because we can do it offline. There's a whole nother presentation to the tax advantages of CareMatters Together. Just for this purposes today, know if you have any business owner clients, think about this as an option for them, because those long-term care premiums can be deductible. On your individual basis, they can be used, HSA dollars can be used to pay those too. So just make sure that you know that. If you have someone who is a business owner and says, well, I'd rather just buy this personally, you don't want to do that. You want to go ahead and let them have the business pay for it. And Brent and I can talk to you about, the reasons and why you want to do that. But it is definitely a great spot for those business owners. And then I mentioned briefly some of the international claims. Just know that we do pay that first bucket. So in the individual CareMatters, it's 2 years. CareMatters Together, it could be 36 months or 48. All of that can be paid out on an international claim. Clients do not have to come back to the States to be certified. There is a US doctor that'll certify them abroad. And then that second bucket that I mentioned, that LTC extension, that can not be paid out internationally with us. They have to come back to the States for that remaining bucket. But again, there's ways to design around that. So if you have someone who's gung-ho and they're going to retire internationally, just give Brent a holler. And then I just want to show you one option to fund, and this is CareMatters or CareMatters Together. A little busy slide here, but just bear with me and I'll walk you through it. In our situation, we've had someone who's over 59 and a half, so there's no hit to taking money out of their qualified account as far as the 10% penalty goes. They're going to take that money and they're going to carve out, in this situation, we've taken $100,000. We're going to purchase an IRA SPIA. So that's really important. I cannot take qualified money and buy CareMatters or CareMatters Together. It goes to a SPIA. So that I know some people out there think, can you use qualified money to buy it? I can't do that. But I can take the qualified money and buy a qualified SPIA and then use those payments. In our example here, Arrow 2, we're going to get $12,000 out on a 10-year certain. That's going to buy the CareMatters, or we could do CareMatters Together in that third arrow. And then that fourth arrow, this is just an example of the benefits that would be received. So busy slide. The main thing to know is if you have someone that says, I've got this excess qualified account, I don't need all of it to live on, I'd like to carve out a portion of it because I'm concerned about long-term care, they can do that. But it goes from qualified funds to qualified SPIA. And there are taxes. I wish I could tell you there's not, but when they come out of that SPIA, there will be taxes paid on that, right? Because it's qualified money. They've never paid any tax on it. So great option for your clients that are heavy in the qualified asset. And then here's just another quick peek on different places to, I always like to say, find the money. Where might that be? Some of the CDs that are maturing. One of our advanced markets folks actually bought a CareMatters contract with a recent inheritance from her mom, so that was a great option there. I have some folks that lease out income or lease out property for cattle and ranching, and so they're like, hey, you don't have that on here, Charlene. So if you have rental income, that certainly can work here as well. And Social Security not needed. A lot of people will carve out a piece of their Social Security if they're receiving Social Security to buy a contract. And just the last slide on Nationwide, a Fortune 100 company. We've been in business since 1926, and we've been offering long-term care since 1999. We started in the space with our long-term care rider, and then we evolved into our CareMatters, CareMatters 2, now CareMatters Together, and there are other conversations on the docket. So with that said, I can stop showing my screen and give that back to you if you want.
Well, I've got a couple questions, so throw those out there and we'll get it all squared away. Let's see here. It says, oh, well, there's only two, yeah. So it says, is it limited to $20,833 because you're trying not to MEC the life portion?
No, actually, most of those contracts are going to be max out of the gate, especially your single premiums. It's just a maximum amount that our actuaries came up with as far as the sustainability for the long term. They felt like that would be, if we started issuing lots of contracts at that amount, might be a little bit too much. We see most of our contracts today issued under that HIPAA limit, which is right around 12.8. So we don't see a whole lot of them in that $20,000 bucket, but most of the contracts will be a MAC out of the gate. So great question on that.
All right, and then the next question here, and the final question is, that is 10% of both or 10% of each payout for the death?
It's 10% of the initial specified amount, so just one. So once they're both deceased, then that 10% would go to the heirs.
Okay. Then that is it.
Awesome. I'm going to jump back one thought on the MEC question, because a lot of times people ask about the MEC and then they think the long-term care benefits are taxable. They are not. So the MEC status is just if for some reason they would pull cash out of the contract, which we wouldn't recommend in a hybrid long-term care situation, but got to notify them because there's it's out there. they can have it if they want it. I wouldn't do it, but
well, yeah, well, that is it. And Donna, I'll get that information to you. So again, this is Miss Charlene with Nationwide. This is what, part two, right? Technically part two. We're gonna call it part two now. So this is part two of Miss Donna, or Miss I'm all turned around here. So Miss Donna, this is Miss Charlene with Nationwide. And yeah, we'll have some more information, things like that. Stan, I'll get with you on that question. And that's about it. So I do appreciate you, Miss Charlene.
Absolutely.
So I don't know, in my mind, for some reason, I see CH. So I want to say Char. Is that still correct?
Yeah, you could. Yep, Char.
Yeah, okay.
I actually have people call me Char, so
yeah, okay. So, I like that. See, part two means you already got a nickname going on. So
there you go. I love it.
But guys, I definitely appreciate you attending. Definitely had a lot of good questions here. I definitely appreciate you answering those questions. Everyone loved the answers, very in detail. And I think, like I said, again, we definitely needed that with this product. We've talked a lot about it. So with that being said, I appreciate it. And I appreciate you guys attending. Again, hope you had a really good Memorial Day weekend. Hope you enjoyed our presentation, Ms. Charlene. I really appreciate you giving us all this information because, again, everyone's looking for it. So this is really good. I definitely appreciate it. And you guys have a good day. Thank you.
Thanks. Good for having me. All right. We'll see you guys.
All right. Bye-bye.